We are still rolling with more Bitcoin mining content, mastering treasury management. I'm joined by three gentlemen I actually just saw the other week. If you guys want to take a seat, Jeff Lucas of Bitfarms is, oh, look at that. We matched up the pictures perfectly. On my right, Drew Armstrong of Cathedra and Salman Khan of Mara. This topic has been on the minds of most people in Bitcoin mining over the last 12 months, especially with MicroStrategy, MSTR, ripping in the markets. A lot of Bitcoin miners have been way more interested in figuring out treasury management strategies to increase their Bitcoin per share. And more than that, also to survive as Bitcoin miners. It's a hard industry. I think these three guys can tell you a little bit about that. And if you're going to survive in Bitcoin mining, you need a solid treasury playbook. So we're going to dig into it quickly. We'll do some introductions, and then we'll roll into some topics. Off to you first, sir.
Well, Mara is a well-known household name in this conference, at least. We're the largest Bitcoin miner in the world with 57 exahash under our capacity. We operate in 4 continents with 16 data centers. And our story has evolved over a period of time. We were not the largest, and we have grown over this period of time and deployed capital responsibly. We have the lowest cost of electricity per coin when we look at this sector, and we're very excited about our mining business. So we happen to know Bitcoin a little bit, if you like, and we produce about 700 to 900 Bitcoin a month, and we hold all that Bitcoin on our balance sheet. The reason is we love Bitcoin. Bitcoin as an asset class has been, out of the last 15 years, 11 years, it has been the best rate of return asset class. It has beaten other traditional asset classes like S&P 500, you name it, REITs, look at other commodities, oil, natural gas, and it continues to produce great rate of return. And it is at the all-time high the last couple of days, so we're very excited about that. Having said that, we are also the second largest holder of Bitcoin worldwide. 50,000 coins approximately on our balance sheet. It didn't happen in a vacuum. We produce Bitcoin and hold it, while we also go out and opportunistically buy Bitcoin from the open market. We don't have to do that like other treasury companies, but we do that as the opportunity arises, and that has produced great rate of returns for us, and we're super excited about that.
Drew, over to you.
Yeah, so I'm the president and COO of Cathedra Bitcoin. We're a publicly traded company on the TSXV. And I think we share the same bullish outlook on Bitcoin as Mara, but we go about that view in a different way. We develop infrastructure with the goal of increasing our Bitcoin holdings on a per share basis. So I think from our point of view, we focus on developing Rackspace because we really think that power in Rackspace is the scarce commodity and is the biggest bottleneck to call it scaling compute of various forms. And then we seek to hold our retained earnings in Bitcoin because, as Salman said, Bitcoin has done very well, but also we're of the view that Bitcoin will continue to emerge as a global reserve currency. And we think that this is really still the early innings of Bitcoin's adoption globally. But yes, our view is basically long Rackspace, long Bitcoin.
Jeff?
Sure. And Bitfarms has been mining Bitcoin, one of the most long-standing miners here since 2017. We've got about 20 exahash, about 500 megawatts currently under management with a pipeline for 1.5 gigs here. We've actually made a bit of a pivot recently here. We've recognized that our thesis here is how do we manage our megawatts to maximize our valuation? And so we've actually shifted or supplemented our activities now by going more into HPC and AI. And the thesis is pretty straightforward here. When you look at valuations, the Bitcoin miners, you see multiples of anywhere from maybe 2 to 5 times. You look at HPC and AI, it's north of 20. So for us, we're realizing a lot more value here by pivoting, being more active and focusing on what's happening on the HPC side. All that being said, we are very active, however, in our Bitcoin management and our HODL management here. But we use a principle called capital efficiency. So rather than just building up the Bitcoin here, we utilize that Bitcoin to fund our growth far more cheaply than equity in doing the ATM here, but also engage in some derivatives activity here to get that same performance, but we do that synthetically. And it works great for us.
And I'll introduce myself really quickly. I'm Will Foxley, co-host of the Mining Pod. I have very little, if any, Bitcoin compared to these guys, but I do get the pleasure of interviewing them every once in a while. Salman, I'm going to throw it back to you. Mara made headlines a few weeks ago when you guys started putting the gas onto the fire of a Bitcoin strategy, the accumulation strategy. You guys announced a very large ATM and the intent and purchase to continue to purchase more and more Bitcoin. Lining up with our topic here, mastering treasury management, how do you guys see actively selling shares and then purchasing Bitcoin accruing value to Mara?
That's a great question. So I want to step back a little bit from a strategic perspective. When you think about us, we are primarily an energy technology company that is focused on Bitcoin mining. And we are good at it. We do it very well worldwide. We accumulate Bitcoin by doing that. I call this a twin turbocharged strategy. By twin turbo, if you drive a car, you know when you drive a twin turbo car, it's very difficult to go back to a car that does not have twin turbo engine. It's slower, it's not as active as you would see a twin turbocharged engine. Mara is not for everybody. If you like driving fast cars, you want to accumulate Bitcoin really quickly by mining at 1/3 of the cost of the price of Bitcoin in the open market, while also going out and acquiring Bitcoin from the open market as the opportunity arises. That is the piece where you would want to hold Mara stock, because we are going twin turbo charge strategy by tackling both mining operations, accumulating Bitcoin through that, but also acquiring Bitcoin in the open market. Now, to go back to your question, look, we have multiple sources of capital, not just the ATM, but ATM has been the primary source of capital in this sector, primarily because this sector was debanked over these years. As you know, SEC did not like this sector previously. The regulations were not favorable to this sector. So generally speaking, banks stayed away and traditional investors stayed away from this sector. So primarily this main source of capital for this sector was ATM. And it still continues to be a major source of capital. Now, having said that, 40% of our source of capital last year was ATM. The rest was other sources. And we like to mix and match. We like to see what is the best source of our capital. It's a capital allocation question. How can we go out and invest and get the best rate of returns for our investors? The money that our investors have given to us as fiduciaries, how can we maximize that rate of return? Is that through the Bitcoin mining side, based on the future curve that we think is going to be the Bitcoin price and the hash price with the global hash rate? Or does it make sense because there's a lot of tailwind with the political push, with the strategic Bitcoin reserve, with the BlackRock and Fidelity and others, and the ETFs launches, and the sovereign world, the sovereigns coming out and talking about holding Bitcoin as strategic reserve, or maybe the sovereigns thinking about, they don't know much about Bitcoin, but they want to use mining as an energy arbitrage. They have excess power and they want to put that power to use. So multiple sources, when you combine that together and you look at our cost of capital, what is the best way of utilizing our capital and deploy that and create the most rate of return for our stockholders? So for example, we did 0% coupon, $2 billion last year, and we went out and primarily bought Bitcoin, while we were also producing Bitcoin or holding on our balance sheet. So it's a combination of different sources of capital. It's a capital allocation question. It's a timing of the market. It's dependent on the macroeconomic conditions. And all of that comes into play when we think about how do we go about and source Bitcoin for our shareholders.
Yeah, I love this topic here because the treasury management part of Bitcoin mining is almost more important than anything else. The ability to survive across cycles. And on stage, we have so many different ways of doing it. So you kind of talked about the financial side of things. You know, Mara being such a large market cap has access to different sources of financing than others. And then down the line, you guys already mentioned some things. So Drew, long Rackspace. Let's get into that next. And then Jeff, I'll finish off with HPC. Drew, you guys are long Rackspace, and you guys build purpose-fit constructions for Bitcoin mining and sell those on the open market for others. And then you also obviously have your own self-mining operations. So tell me about that way of accumulating Bitcoin.
Yeah, so we were on a similar panel. I guess 3 of the 4 of us were on a similar panel a couple of weeks ago at Consensus, and I told Salman then that I was going to steal his twin turbo strategy analogy. I think for us, the twin turbos are, again, developing these data centers, these fit-for-purpose data centers, and then obviously also accumulating Bitcoin. And the reason why we like to develop this Rackspace and lease it out as opposed to buying ASICs is because we think ASICs are a trade to put on, but not a good way to predictably compound capital. And so for us, we think that developing these data centers and leasing them out has a better risk-adjusted return versus buying ASICs. And I think that's for a few reasons, but also we think there's a strategic benefit to own the rights to power as well, because you then also have a call option on future types of compute like AI HPC that might be able to monetize that power in a different way. So we develop these data centers, lease them out. Historically, our capex per megawatt has been around 170,000 per megawatt, and even if you add some sort of CYA adjustment to that, we're still you can conceivably earn a 50 to 100% cash flow yield, which means up to a 1-year payback, perhaps a little longer. But we think that that's a really good risk-adjusted return. And then to maximize our sort of upside exposure and to express our belief in Bitcoin, we'll save those retained earnings in Bitcoin. And I will say in September of last year, we put out a Bitcoin Treasury strategy memo. This was at the time, the Bitcoin Treasury play was a little less in vogue than it is now. I feel like we've seen about half a dozen in the last month or two. But at the time, we sort of expressed that was what we're going to try to do as well, but not always through dilution. Since then, we've not taken on any dilution, but we have increased our sats per share by around 16 to 17%. And on an annualized basis, that's around a 26% sats per share yield, or Bitcoin yield is what some of the other treasury strategies are calling. So for us, again, we think that developing this Rackspace and then accumulating Bitcoin through our retained earnings is a great way to, one, have better risk-adjusted returns on sort of a project investment basis, but then also increasing our Bitcoin holdings because, on a long enough time horizon, we are incredibly bullish on Bitcoin. It may go down in the short term, but we think that we're really looking at, innovation in a world-changing asset. And I think we're really witnessing one of the great wealth transfers in human history for those who have the foresight to start accumulating Bitcoin now. I think in the future, we might opportunistically raise capital at the right terms so that we can put some accelerants on that and accumulate Bitcoin even more. But we might also use that capital to develop new data centers. And I think having those two levers for growth makes it easiest for us to always be opportunistic and never forced into growing in just one direction. Because I think it is something we saw, in the last 5 years. A lot of folks were so focused on hash rate growth for its own sake. And I'm not saying the gentlemen on this panel were among them, but I think many miners were stuck on an ASIC hamster wheel where the only way to grow was to buy new ASICs, even if at the time it wasn't a great investment. So that's really the main thing we're trying to avoid with our twin turbo strategy of long Rackspace, long Bitcoin.
So our decision actually to go into HPC AI was driven by something very similar principles to what Drew spoke to, and what they call in the banking world RAROC, which is indeed risk-adjusted return on invested capital. For us, that RAROC is far superior in HPC and AI than it is in Bitcoin mining. First of all, as we all know, the technology curve for increasingly new miners that are more efficient here, it's very, very expensive. And the question is, does a company ever return or achieve a return on that continuing investment? We're focused right now with HPC AI on the E and PE, which seems, I think, to defy a lot of what the miners are doing, because how many of them actually have consistent earnings going forward? We find that there's a fundamental demand in HPC AI that's going to drive to actually a more consistent earnings stream going forward here and a better use of capital. So for us, it's really twofold of getting involved with HPC. One, you've got this very profound demand here. Look, at studies have shown that the expectation is that by 2030, $5 trillion will be invested in HPC AI, and that the power requirements will go to about 156 gigawatts. Now, with that thought in mind, keep in mind here that mining right now uses under 20 gigawatts. So the potential there is immense. But very importantly here, with that RAROC here, with the earning stability and the profound demand of HPC AI, we can finance that with debt. We've always been very focused on minimizing our dilution, not tapping aggressively into our ATM. In Bitcoin mining, you need to use equity. The volatility, the variability really mandates actually doing equity financing. The beauty of HPC AI is that we can use debt financing. So for our financing of our HPC data centers here, we're using debt. We're paying maybe 8 to 10% as the cost of capital here. And on top of that, as I mentioned before, you get maybe a 4x valuation in the 20s versus the 3 to 5 that's actually in place here, within Bitcoin miners. Now, we actually value our Bitcoin very much as well, and we use this premise of the capital efficiency. We rely very heavily on the derivatives markets, and we've used them very, very effectively here. You get returns at parallel actually holding the Bitcoin without having to put our precious capital into the Bitcoin holdings for it. It's worked out very, very well for us. It allows us to employ leverage. It allows us to employ what's called convexity in terms of our options and futures trading here. It brings a very attractive return overall.
Okay, we got about 8 minutes left here, and there's tons of questions to go to. So we're going to do a snake draft and go back this way. So, Jeff, I'm going to throw it back to you. When we talk about the convertible bond market, that's been a very interesting source of allocation over the last 6 months. Kind of slowed down a little bit. People have been looking more to ATMs or even debt structures. We've seen a lot of debt with Coinbase recently, where you're putting your Bitcoin up and then you're able to pull some sort of debt function out of it. How are you looking at that market when it pertains to Bitfarms? When is it the right time to call that sort of capital? And why would you do so in an AI HPC setting right now versus when you were historically looking at Bitcoin mining?
So first of all, for us, it's far more attractive actually to do straight debt than it is to do convertibles here. You have that equity element, it's much more expensive there. So for us, it just makes a lot of sense here. It's also very important to understand, I think if you're one of the largest players like Mara, you can get pretty opportune pricing with your convertible notes and convertible debentures. However, when you're a mid-sized miner, and you really need to understand what is the all-in cost of convertible debt. By way of example here, you may have to actually engage in what they call a synthetic borrow. That can be expensive. You have to have put in place a buyback provision, which can cost several $100 million. You have a provision called a capped call, which allows you to convert at a higher level than what's stated in the doc. All those things take away from however much you borrow. You still got to repay that principal down the road here. So when you factor in all the costs of doing a convertible debenture, you realize that actual cost of capital is much higher than would be seen at face value. For us, we feel we can get a much better return and a much lower cost of capital by really engaging straight debt.
Love it. Okay, Drew, over to you. I want to just continue hitting on that Rackspace idea. Like, when you come to the point of like being a smaller miner, you guys don't have as much hash rate. How do you value that Bitcoin HODL? And I'm a Bitcoin bull. I think it's going to 1 million. Is it just about increasing the Bitcoin on the balance sheet per employee or some other metric? Or are you guys trying to race and use this Rackspace model to get to where some of your peers are, 10, 15, 20, 50 exahash?
Yeah, so I think for us, again, it comes down to just sort of being opportunistic, but our goal on the long term is to increase our sats per share. And so, that might mean that Bitcoin balance goes down for a period of time if we think there's a really attractive opportunity to grow our Rackspace, grow our power footprint. But again, we think in the long term, Bitcoin is going to be one of the best performing assets of human history, as it's already been over the last 16 years here. So, I think for us, it really comes down to being opportunistic. And because we're a smaller miner, I think as of today, before we got on here, our market cap is something to the tune of $48 million. We're much smaller than the two gentlemen I'm with on stage. As a result, I think we really just think about things in a return on invested capital point of view, and it forces us to be really disciplined about thinking how we grow and how we deploy capital, and forces us to be quite lean, which I think is important. So, we consider also non-dilutive ways of growing, using things like Bitcoin-backed debt. I think Bitcoin-backed debt, many things Jeff said is spot on. I think in particular, Bitcoin-backed debt is really the most mispriced risk in the world. But one thing that many folks are going to need to remember is that rehypothecation and the low coupon that comes with it also introduces its own risk. But I think to the exact question, I think with the long Rackspace, long Bitcoin thesis, really it comes down to being opportunistic and going where the best opportunity is, which is nice because then we don't only have one way to grow, which is something I think has plagued miners in the past.
And it's not just about accumulating Bitcoin. So, Salman, I want to throw this question to you as we're getting close to time. We have a few minutes left. It's not just about accumulating, but using that Bitcoin. So you guys have a headline as of last week where you're putting some Bitcoin out with 2 Prime to get some yield on top of it. Tell us a little bit about that debt structure, or at least that structure that you guys are putting the yield out. Someone's using that Bitcoin on a productive basis, and you guys get to benefit from it. Why do you do it? Who are you using for these sort of services? And what's the long-term benefit for Mara and Mara shareholders?
So before I answer that, I want to step back a little bit and ask the audience here by raise of hands, how many of you like Bitcoin? There you go, vast majority of us, right? Would you want to hodl Bitcoin or not? Okay, that's great. So the reason I ask this question is you have to first define why are we hodling, right? Why are we keeping this on our balance sheet? Because this is a once in a lifetime unique opportunity to invest in an asset class that in my lifetime I've never seen before. And I come from traditional finance background as it can be. Oil and gas, renewable energy, technology background, and advisory in the past, right? When you think about Bitcoin as a category, you want to hold that and see the appreciation of value on the balance sheet. But while you're doing that, there's opportunity to place that Bitcoin and earn a yield on it. Or just think about it, not a great example, but a fiat example. If you have cash sitting on your bank account, you don't want that cash to be sitting idle and not creating value for you. You want to place that in treasuries or other places where you can earn some yield on it, right? So the same concept, although not a great example, we all don't like fiat, we like Bitcoin. You take that to Bitcoin as an example, you want to create some kind of a rate of return while you're waiting for the Bitcoin price to go up. When we made the decision last year to hold all our Bitcoin on the balance sheet, Bitcoin was priced at $45,000 per coin. Today it's touching $110,000, $111,000 per coin. Think about the thesis of the rate of return for our investors. So we like the capital appreciation. But then while we're doing that, we want to place responsibly because this is our hard-earned money that we want to place with people that we trust. That when we need that Bitcoin back, those people will be available to return that Bitcoin back. And 2Prime is one of them that we announced fairly recently. We've worked with 2Prime before, and we've worked with almost everyone in this industry. But we take the Bitcoin and place them in treasury management, if you like. And this topic by itself can take half an hour to discuss. I know we have just a minute left. But the concept is that we expect to create a rate of return, let's say mid to high single-digit rate of return on an asset which is already giving us 150% rate of return on a capital appreciation basis on a year-to-year basis. So what that does is it helps us pay for our expenses. It sweetens the deal for us for holding the Bitcoin for a longer duration of time on the balance sheet and continue to see the appreciation from a long-term perspective. So we're excited about that, but yet as a public company, we are careful around whom do we place that Bitcoin with and what is the risk that we take in placing that bet. So that's a summary of it.
That's perfect. And that is time. Put your hands together for these three gentlemen, Jeff, Drew, Salman. Thank you so much for joining. That was Mastering Treasury Management, how to accumulate as much Bitcoin as possible. We're going to jump off stage, but don't go anywhere because we have an amazing panel up next. Something about heat reuse. It's kind of a big topic of Bitcoin mining these days, right, Drew? So don't go anywhere.